Reporting season, it's that time as well with some of the country's biggest companies set to release its earnings this week. What companies should you be focusing on? Well, Marcus Bogdan, Chief Investment Officer at Blackmore Capital, joins us live now from our Melbourne studio. Marcus, it's a pleasure to have you on the program today. It is a big week ahead for reporting season, but before I get to that, I want to get your view on the banks in general, because of course today we're really focused on the Royal Commission report, which is due out just after the close. So we won't have any new information, of course, until after the close today. But certainly the banks have been increasing in shorts in the lead up to this. There's been a lot of negative sentiment around them. How are you playing this heading into the report, and what are you expecting, I guess, for trade post this report?
Sure. Good morning, and thank you for having me on the program. Well, the banks have actually underperformed the broader market really since 2015, after a golden decade of outperformance. I think the core question is how much of this is already reflected in the share prices. You've seen a de-rating in their return on equity, their margins, and their growth rates. I think that what we can see from what has already been released in the interim report is how these banks going to look, and these financial institutions going to look in 3 to 5 years, and what is the structure around vertically integrated banking models where you've got both advice and product manufacturing. That is you're starting to see that with 3 out of the 4 banks being that process being dismantled. So I think that is a key factor. I think the initial FOFA draft recommendations will be, which were not implemented in FOFA. I think they will be tightened, especially around fee for service and grandfathering. But I think broadly, most of what we've seen in the sector, and you've seen reductions in share prices of greater than 10% over the 12 months, has started to be reflected in those prices, and so there may be some sticker shock going into these announcements, but then we will look at very carefully at whether weightings in the banking sector are appropriate. We have been underweight the banking sector for a considerable amount of time, and whether this, if there's any further downturn, whether this is actually an opportunity to start building back into those 4 major banks.
Yeah, that's the question, isn't it? Is this an inflection point? Because we have been waiting for this point. There's obviously a lot of uncertainty in the banks anyway, with the housing market, what we're watching in the global economy as well, and how that impacts the banks going forward. We know wholesale funding costs are on the rise. We know bad debts is something that we're focusing on over coming years. But still, do you think that, as you said there, if this report is a little better than expected and what we see out of it perhaps a little softer than expected for the banks, that we will see some more buying into those big 4?
Yes, potentially, and I think there is from an institutional perspective, there is an underweight in that sector, and so that could provide some sort of fillip for the banks going forward. But notwithstanding that, I mean, earnings growth going forward will be subdued. I mean, we're expecting very low to flat earnings growth going forward. I think from the report you will see the continued rise of compliance and regulatory costs, which will be an impost on earnings growth. So I think we need to be realistic in terms of the growth rates that can be projected by the banks, and that's certainly being reflected in lower PER multiples. And the other aspect of being an investor in these banks is, one is the capital growth reflected in earnings growth, but also the ability to maintain their dividends at these levels, given that you've had an uplift in capital requirements, payout ratios are quite high. We would tend to favour probably ANZ and CBA at this point in time. Well,
isn't it interesting that CBA is out with its half-yearly report this week, I think on Wednesday, so they only have about 1 day to trade in light of what we see in the Banking Royal Commission before they have to sort of have new news released to the market. What are you watching for CBA? And you say it potentially could be a top pick out of the big 4, that and ANZ. Are you watching for any positive news to come out of that reporting season number on Wednesday?
Well, I think CBA's capital position is certainly the strongest out of the four, and their capacity to either initiate a buyback or to be able to increase their dividend will be something that we will watch. We will certainly be watching just whether bad and doubtful debts are starting to rise from record lows, and the way that they're trying to combat higher cost structures is through obviously digitalisation and automisation, and how that is progressing through the bank as well. No doubt there'll be further discussions on regulatory issues, especially around responsible lending, which we will focus on quite carefully, not only from the consumer end, but whether that impacts small business or not, which is one of the key tenets of lubricating the economy.
All right, want to talk a little bit as well about what else you're watching in the reporting season. Anything else on your radar? Because obviously it really kicks off with vigour this week.
Yes, it does. I think first and foremost, looking at whether companies can return franking credits. There's 45 billion franking credits sitting on the ASX 200 balance sheets, with the potential change in franking imputation and cash refunds. There is a sense of urgency of whether a number of companies with excess franking credits can return those to shareholders. And there are a number of stocks that we're interested in and we are looking at in this space. So there's Alumina, BHP, Caltex, Washington Soul Patts, which is a shareholding in Brickworks, and then Woolworths, Wesfarmers and Woodside are all potential candidates to returning back some of those franking credits to shareholders. The second element that we're really focused on is just sort of understanding the slowdown in earnings growth that you're starting to see. The confession season prior to the formal announcement of reporting has shown a skew to the negative, especially in retail. You saw a downgrade from Kmart. What the effect of a slowing housing market has on those retailers and on the broader economy. And then you saw a downgrade by Boral this morning as well. So that's the second element. The third element is around growth stocks, in the healthcare and in the technology sector, where they have been trading at significant premiums to their long-term averages based on very, very strong earnings growth, and whether they can maintain that. You saw last week with ResMed, which disappointed the market, and they contracted over 20% during the week. We'll be focused on, in the healthcare sector, principally CSL, which has had an extraordinary history of growth, and then in the technologies sector, looking at Xero.
Yeah, there's so much to watch, I guess, in terms of the next few weeks. It'll be very interesting to see how this impacts strategy going forward and markets more broadly as well. We really appreciate your time, Marcus, but we're out of time. Thank you so much for joining us today.
Thank you.